Hi and welcome to a new episode of The Financial Fox. Today I want to discuss investment strategies more generally during this time of market uncertainty. Many investors watching are wondering how they can invest without their money getting wiped out again, how to preserve their wealth, and also see returns through those volatile months. The Bank of England is talking about negative interest rates, which is not good. Unemployment and inflation are rising, which is bad. And the government's priority of strengthening the economy is being challenged by a new wave of coronavirus. And obviously, everybody's worried about it. And on the top, there is political uncertainty over Brexit talks, US election, and geopolitical tension. So what are the best strategies to consider right now? To answer this, I will be joined by Clem Chambers, British investor, award-winning financial author, and of the London-listed financial news platform ADVFN, and also the blockchain developer Online Blockchain. Let me connect with Clem and let's discuss this with him. Hi, Clem. How are you?
I'm good. Thank you very much. How are you, Steffi?
I'm okay, surviving, let's say.
I hope you're doing better than that.
So what we would like to discuss today is some investment strategies, because, we are seeing that things are not really going in the right direction. I mean, the Bank of England is talking about negative interest rates, and then we see inflation, unemployment rising. The government is panicking because of new wave of virus. What is your take on markets?
Well, I always like to boil things down to a simple yes or no call. The master call. What is the call to make? Well, for me, is it going to be deflation or inflation? And the economists say, oh, deflation, oh, terrible. Although I think that they have a bit of an axe to grind, because they are basically working for the government. And the government is printing money. So if you were an economist and you said, oh, there's going to be inflation, look at those government printing money like nobody's business, they're spending like drunken sailors, there's going to be inflation, they might have a problem from their employer. And I always say, if economists were so clever, they'd be working on Wall Street and they'd be trading and making fortunes rather than being professors in universities. But that's a little bit maybe snarky. However, the people in the market, the Warren Buffetts of this world, are saying inflation. I mean, Warren Buffett just bought a gold share, Barrick Gold, and he's being absolutely, a not gold bug. And for the first time, he's bought a gold mine. Well,
he's also buying Japanese stock as well.
Yeah, which is what I was going to move on to say. He's buying Japanese stocks. You might say, what's that got to do with inflation? Well, if any place is not going to get it, it's going to be Japan. Because Japan's had zero interest rates. There've been all sorts of things to try to get inflation. It's not actually true, but they say they're trying to get inflation. And so if you want to buy stocks denominated in a deflationary currency, you want yen. Yen is a currency least likely to inflate because of the way that Japan handles its printing. Their long-term strategy, which they don't talk about because it would seem a little bit strange, is less people on our island. Let the old people live forever and then pass away and leave all their money to the younger generation. Let the money come downhill that way. We used to have 60 million people here in the 1950s. We've now got 120 million people and there's too many of us. Let's get that number down. No, we won't have immigration. Yes, we'll have an aging population, but at some stage, those old people are going to die and the demographics are going to mean that the money's going to roll down to the young and there will be the ultimate luxury of space. And it'll help the environment too, because ultimately all this environmental stuff that goes on is all about world population. Too many people, so they say, if you want to boil it down. Okay, so Japan's got that covered. It's going to have deflation. It's going to have a shrinking population. And in 30 years' time, it's a really short time. It's something like in 50 years, they'll be down under 90 million people. In fact, in like 2 or 3 generations, they'll be back to 50 million people. So that's a deflationary environment. That's where you want to put your money if you don't want to go to cash. So anyway, that's what, if you're worried about inflation, you want to have inflation hedges. And therefore you want to put your money into things that get more valuable as the value of money goes down. And that's what Buffett is doing, because he sees you can't go around printing money and spending it like a sailor and not get inflation. Where the economists say, well, you can print money as much as you like, QE proves that, and it doesn't escape the banking system, it doesn't escape into the hands of people who are going to spend it, it all gets stashed and hoarded, and you don't get inflation. So there's the two poles. Now, I think it's going to be inflation, and I can go on about why I think it's going to be inflation, how obvious it's going to be inflation, but I could be wrong. You know, every 10, 15, 20 years, I'm wrong about these things. But you don't have to care whether I'm right or wrong about inflation. You need a strategy. And the strategy is very, very simple. In fact, I was told today by somebody that it's straight out of the Old Testament or the Talmud. I don't know, I've never read the Talmud, but apparently this strategy is in, you know, when Moses was bringing the tablets down, he was suggesting that you do this as an investment strategy as well. So I didn't just make it up in a sense. And that is, you keep a third in cash, you keep a third in stocks, and you keep a third in inflation hedges. And then you decide which way it's going. Now, if it's going to get deflationary and you feel that prices are falling and money's getting more valuable, then you lighten up on your gold and you lighten up on your crypto, and you push that into stocks, perhaps, maybe growth stocks. And if you think it's going to be really quite bad deflation, you move it out just into cash. You go to cash. Deflation, go to cash. You're going to get a great return on your cash. Your cash just gets more valuable. Maybe you see if you can find a little bit of yield, but it doesn't matter, because, you know, if there's zero interest rates, or you've just got a pile of notes in a safe deposit box somewhere, and the value of that money is going up 6% a year, well, you just made 6% because you can buy 6% more stuff. It doesn't matter whether your pile of savings goes down, as long as it's going down slower than the value of money is going up, you're in good shape. Now, obviously, if you thought there wasn't going to be deflation, there isn't going to be inflation, it's all going to come out in the wash, everything's hunky-dory. Don't worry about the fact that everyone's working from home. Don't worry about the fact that all the retailers are going bust. Don't worry about the fact that all the office buildings are going to stay empty. Don't worry about all that stuff. It's going to be just fine. Then you just stick with what you've got, which is, you know, mainly in shares, maybe a little bit of bonds, a bit of cash, and a bit of gold. And then, if you're like me, you're going, oh, it's going to be 100% inflation in the next 3 to 5 years. Then you shift out of cash and you shift into equities, into gold equities, precious metal equities, and then into physical precious metals, and then into crypto at the far end. And the more inflation you think it's going to get, the more you turn the dial towards that. And if you think we're going to get, you know, Venezuelan inflation, it's going to be Zimbabwe, then you go to gold and crypto. And in fact, you don't even go to gold, you go to crypto, because, you know, if you're in Zimbabwe, the only thing you want to do is leave. And if you want to leave that sort of dire situation, if you are apocalyptic about it, and some people are, and I can do apocalyptic, especially today when the market's down 3%, you want to be in crypto, and that's how you turn the dial. So you go, well, it's going in, oh no, it's going to inflationary now. You can flip cheaply between inflation hedges, i.e. gold and crypto, and gold shares and cash. And it doesn't cost you much to move between the two. If you start moving in the wrong kind of assets, it gets very expensive. But those assets are cheap and fast to move between. And so that is the strategy that people should take. And then it's to judge for themselves how much inflation or deflation they think is coming.
So when you are talking about shares, which kind of type of equities do you think investors should look at? For example, maybe they shouldn't be looking at banking at the moment. Maybe they should look at other sectors.
Well, I mean, I keep looking at shares thinking I shouldn't have any. I mean, I look at shares and I go, thank goodness half my shares are gold mined, proper ones that actually dig metal out of the ground. And some of them even pay dividends, thank you very much, right? So I look at the other half, which are really good companies that have been smashed down kind of unfairly. I mean, it might not be the cleverest investment of all time today, but Marston's did a deal with Carlsberg, which values that company, which they own half of, as about, well, 100% more than the company's valued on the stock market today. So if their brewing business, and after all, if one thing's not going to go out of fashion, it's going to be beer. If that is worth what it's agreed it's worth and what everybody seems to think it's worth, Masters is at half price. So you say all that property, all that business in the pubs, which obviously might get closed down tomorrow for a few weeks or months or maybe never come out ever again, is actually a liability of half that overall value. Well, I don't think that's very likely, but the market, I got crushed with that today. And I've got lots of lovely cheap companies. I mean, Marks and Spencer's owns half of a large chunk of Ocado, which is worth £19 billion. And Marks and Spencer's is worth £2.5 billion. Their share of that business is worth more than the whole of Marks and Spencer's put together. But today, so it's a very tough place to be outside of something that you've got 1,000% certainty in your mind about. And you know, it's what's going to happen next is very difficult to judge. You've got Trump going to get kicked out. What's going to happen to the American market? The American stock bubble is totally scary. They're printing money like water. They're handing it out, you know, willy-nilly in all directions. And UK is going to get locked up again, which is going to be catastrophic. So, you know, it's such a mixed picture that stocks are very hard to judge. I believe inflation, so half my portfolio, which is half of what I could have in it, is in gold stocks, which I feel is a little bit in a comfort zone. Even though if the balloon goes up, everyone's going to be selling shares willy-nilly, and gold will go down because people will have margin calls and have to sell their gold to cover their margin calls. And in the short term, that could spike everything down into the dumps in the short term, but you can't time it and you can't know it's going to happen. So you just have to pick what you firmly believe in under your own model, and you know, hang on or clear the decks. And as I think that inflation is coming, I'm happy to be heavily in crypto, heavily in shares of precious metal companies. I'm not so comfortable with my quarter of a portfolio of non-precious metal stocks, and I've got a pile of cash, which is, you know, it's another thing to worry about. You know, where do you put your cash? Exactly. You certainly don't put it under your bed. And banks, well, that's a little bit, you know, touchy. What I've done there, so you can look at it again. You can go, right, oh, okay, I've got it in cash. But which is the one that's going to inflate? America, so I don't want dollars. How about Europe? Well, Europe's not so bad. UK, well, if they lock down again, they're going to be printing like the Sunday sport money. Yeah, so maybe the pound isn't so great. Maybe it's great. It's down to you to decide. Me, I like the yen. So I've got a big chunk in Swiss franc and yen, because they're the deflationary currencies, or the least inflationary currencies. So I want to hold my money in the least inflationary currencies because I believe in inflation. Now, if you believe in deflation, again, you want to be your money. You want to be in the money where the deflation is the worst. Well, again, you'll probably Swiss franc's a bit different because they're trying to lock themselves into a situation which is that they want to track Europe or the world economies, so that when the whole world shows up at their door saying, I want Swiss franc, please, they will say, you know, oh, we're going to sell Swiss francs and try to keep the price down because we're going to peg to the dollar or the euro. And I think that pegging is a perhaps not such a great thing with the Swiss franc, but nonetheless, it's a situation where you don't want the Turkish lira, right? So as you move away from the Turkish lira towards the euro or pound, towards the euro, towards the Swiss franc, towards the yen, you're betting on inflation coming. Now, if you've got a lot of courage and you believe in high inflation, you just go out and borrow lots of money.
Oh, you mentioned crypto, you mentioned gold. What about properties? Do you see them also as a way to turn the dial as inflation is going up?
There's some, I'm not mad on property because it nails you down. It puts you on the spot. And it depends on how apocalyptic you are about the situation. Personally, I'm sufficiently concerned about developments in certain places that I wouldn't want to have an asset nailed to the ground in any country. I want to be able to move it. If I've got real estate, you can't move it. I have real estate in various places and it's a mess. I've got some real estate in the Middle East. It's a mess. Yeah. Rentals have halved in the last 3 months. In fact, rentals have halved in Australia. So what does that do to the value of real estate? Real estate is incredibly valued because of the leverage of people can buy property, and they've had a run of half a century of rising relative prices in real estate. So the world is a zombie fan of real estate, and I make no judgment about that. They've been right for 50 years. Who am I to say that's wrong? And I've got some of my own, so who am I to say that that's wrong? However, I don't fancy highly valued assets, really highly valued assets. And when house price differentials to salaries have gone up so high, there's room for them in an inflationary environment to not go up much. Yeah. Because actually, what's going to happen is this. Everyone's got a lot poorer. That's what's happening. We've got a lot poorer. You can think, well, what's happened? But everyone's taken a 6 months holiday, 5 months holiday, 4 months holiday. That just means we're poorer. In the same way as if you had taken 3 months off, you'd come back 3 months off poorer. Right? The whole economy of Britain and the world is 20% poorer. And I say that because if you look, or maybe 10, that's a bit kind, 10. If you look at Japan, Japan's imports are down 10%. You can say, well, they don't have to import it anymore. They're keeping it at home. Well, their exports are down 10% too. Now, that's a country that doesn't have inflation, and it's a very boring case. They haven't really been attacked by COVID too bad because they've managed to keep it under control. And yet, their overall economic activity has dropped by 1/10. Now, that's bad. But if you're a government, you take that private sector activity and you tax it. And some of countries, particularly in the West, tax it 100%. They take every single GDP unit in tax, and then they redistribute it throughout their economy. So when you have a 10% drop in the private sector, you have a 20% drop, actually, of the overall system, because the government's 10% that it spends came from the 10% the private sector made. So when that drops 10%, they don't have 10% to spend anymore either. So it doesn't go from 100 to 90, it goes from 100 to 80, right? So what that tells you is we just got poorer. And how could we not get poorer? Because economic activity has dropped. And that's where wealth comes from. It comes from people making stuff. The fundamentals, even Karl Marx, in fact, Karl Marx would have told you that to your face, is people taking mud and making stuff. Yeah, labor plus mud equals stuff. Well, if the labor's not digging mud and making stuff, you just got poorer. And the whole world has got significantly poorer. And therefore, things are worth less because there's less money, real wealth, to buy the stuff. Yeah, so everyone's got poorer. So things like assets drop by that amount, which is why when you came out from the Second World War, you could go and you could buy a beautiful gold coin of Charles II called the Triple Unite. And by 1972, it had gone up 2,000% because there wasn't any money left at the end of the Second World War. People couldn't buy that stuff. You couldn't go out and buy a silver coin for your collection. Nobody had any money. They could barely afford to buy the food. So that sort of stuff, those assets, those premium assets, those flash flats, those Lamborghinis, those old Bugattis, those diamond rings, all that stuff goes down.
They go for renting.
Well, you can go and rent a nice apartment in Australia now, in Sydney or Melbourne or Adelaide at half price. So for the same money, if you've got the same job and you're not going to get fired and you're just as well off, you can get a place that's twice as big. And that is what happens when countries get poorer, because the people in work get richer relative to the other people, right? The assets go down so they can buy them up cheap.
So Clem, what's about the crazy valuation of the big tech stock in the US? Is that going to be sustainable?
Yeah, I mean, it's an embolism. It's a money embolism. Yeah, what's happened is the Fed's printing money and it's not getting out of the financial system. And the financial system is sticking it in those big liquid companies because it's a vicious circle, virtuous circle. If you're a shareholder, it's definitely virtuous or was virtuous. So those, let's put a word to it, insane valuations, yeah, are driven by the Fed printing money. And the way that that system works is that that money's trapped. It's trapped within the financial system because the only people that are able to borrow it are people with collateral. And the only people with that sort of collateral are financial people. right? So if you want to borrow money, that's fine, but back it up. If you want to borrow $1 million, where's your $1 million? Well, now you've got 2. Well, you take that 2, you buy more collateral with it. Now you've got 4. It kind of decays, but you know, even a market like me on that basis can lever up my collateral 400%. Now you start being a hedge fund and you're out to do it and you want to do it, you can probably get 10 times, 20 times. And as the vicious circle goes up, so you get more collateral. So you borrow more money, you put it into the same thing and you get more money. That is what vicious circles are all about, or virtuous circles are all about. But at some point, that's what bubbles are all about, which is what this is. At some point, the mathematics can't support it anymore. And then boom, dot-com crash. Boom, 2008. That's the cycle of boom, bubble, bust. And we are in America right now into the end game. And I've written some articles for Forbes and got millions of views about it. Probably because I had game in the word and it's a load of kids reading it. But anyway, we're in that end game and it's gone vertical. Now, whether it will go vertical again or not, I don't know. You may have seen it because the patron saint of stock prices is about to lose his job. And Donny is going to get replaced by, you know, the other guy. I'm like, yeah, I'm getting old. I can't remember anything. But anyway, you know, Donald Trump's going to get kicked out. So the big question in America is what happens when that happens? And that's only a few weeks away. And that's going to get pretty spicy.
Yeah. So we just basically, investors have to watch and see and then make their own judgment. And
well, if you can't sleep at night, you should be in cash. That's always a golden rule. Yeah. And if you can sleep at night, you know, you should navigate, you should come up with your own big call. What is the big yes or no? What is the up or down? All you ever have to know in the market is which way is the market going. That's all you have to ask yourself. Is it going up or is it going down? Now, I say it's going down. I've been wrong, but I think it's going down, and I think it's going down a long way. I think we've had a 1930 style bump, and that's pretty rough. And so does Buffett. I mean, he said it in his AGM, and if you want to read it and kind of, you know, be really sort of depressed and worried, and when you're listening to him, all you'll hear is the 1930s coming out of his mouth. And I think there's a high probability of that. But if you think it's all going to come out in the wash, then there's probably lots of buying opportunities along the way. But you have to decide which way the market's going or come up with your own big call. And my big call is inflation versus deflation and how to position myself on that, which is to pool my resources between cash and inflation hedges, depending on how the story unfolds. And everyone else, you know, not many people are going to have a big strategy. And therefore, they're likely to come unstuck. Because if you have a big strategy, you at least have got some fixed stars to navigate from. And that's important in rough seas.
I agree. I think that's a very important point. Clem, thank you so much.
Thank you, Steffi.
Okay, so this is everything from the Financial Fox today. I hope that you enjoy the interview, and please do subscribe to our YouTube channel to stay up to date with our news and our interviews. I will see you next time.